10 days, 2 rulings, and most retail investors completely missed both of them. On March 17th, 2026, the SEC and CFTC issued a joint declaration classifying 16 crypto assets as digital commodities. Not securities, not unregulated speculation, commodities. The same legal classification as gold and oil. 10 days later, on March 27th, the SEC approved 91 crypto ETF applications in a single day. The single largest ETF ruling in the history of financial markets. And then the market sold off. Bitcoin dropped. Leveraged longs got liquidated. Retail investors looked at that price action and concluded the story was over. It was never over. What actually happened between March 17th and March 27th was institutional positioning on a scale that retail investors don't have the framework to recognize until it's too late. I'm going to give you that framework right now. Stay with me. Let's build the full picture because the sequence here matters more than any single date. March 17th, the SEC and CFTC don't just issue guidance. They issue a joint declaration. That is not a normal regulatory event. That is 2 of the most powerful financial regulatory bodies in the United States speaking with a single voice. And what they said changed the legal landscape for digital assets permanently. 16 assets, officially classified as digital commodities. I'm going to read that list right now because you need to know exactly what we're working with. XRP, Ethereum, Solana, Cardano, Chainlink, Avalanche, Polkadot, Stellar Lumens, Hedera, Litecoin, Dogecoin, Shiba Inu, Tezos, Bitcoin Cash, Aptos, and Algorand. That's the clean 16. March 27th, the SEC approves 91 crypto ETF applications in a single session. Bloomberg Intelligence had put the probability at 95% for the leading XRP products. The approvals came through and the market immediately sold off. That Bitcoin dropped from $72,000 to $66,600. $300 million in leveraged long positions were liquidated inside of 24 hours. Now here's what retail investors got wrong. They saw the sell-off and read it as rejection, as a signal that the institutional thesis had failed. What they were actually watching was the oldest institutional playbook in financial markets, the engineered flush. Buy the rumor, sell the news, shake out the retail leverage, and then reload at lower prices before the real capital rotation begins. And this is not speculation, this is mechanics. And right now the compression is reloading. Here's why the commodity classification is the foundation that makes all of it work. Securities have to register with the SEC. They carry disclosure requirements, legal liability. The moment an asset carries a securities classification, institutional compliance teams put it in a drawer and walk away. Commodities don't have that problem. Commodities trade freely. They can be held in ETFs. They can be custodied by national trust banks. They can move through institutional infrastructure without a compliance nightmare attached to every transaction. The March 17th ruling was the green light. The March 27th approvals were the starting gun, and the sell-off was the final shakeout before the compression event fires in earnest. But here's the critical thing nobody's explaining, and this is why this video exists. Not all 16 assets are positioned equally for what comes next. The difference between the institutional winners and the also-rans comes down to the 3 specific filters that Wall Street applies before they commit real capital to any digital asset. Let me walk you through all 3. Here is the framework Wall Street actually uses to decide which of the clean 16 gets real capital and which ones get ignored. There are 3 filters. Every institutional desk applies some version of all 3 before they commit capital to a digital asset. Most retail investors evaluate crypto based on price, community sentiment, and social media momentum. That is not how institutions work. Institutions work in risk-adjusted frameworks. They work in compliance-cleared pipelines, and they work in liquidity thresholds. Here are the 3 filters. Filter 1, ETF pipeline. Does this asset have a spot ETF product that is approved, operational, and attracting institutional inflows? This filter matters because an ETF is not just a price vehicle. An ETF is a compliance-cleared wrapper that allows pension funds, endowments, sovereign wealth funds, and registered investment advisors to hold the asset without triggering custody or securities law complications. Without an ETF wrapper, those categories of capital cannot legally participate. XRP had 7 spot ETFs in the pipeline going into March 27th. Bloomberg Intelligence had called the approval probability at 95%. They were right. The approvals came through, and with them came $1.44 billion in confirmed inflows. $164 million on day one alone. A 35-day consecutive inflow streak before the approval date proved that institutions were not waiting for permission. They were already positioned before the gun fired. For Ethereum, the ETF infrastructure was already operational. Inflows have been steady. The commodity classification on March 17th simply removed the remaining regulatory ambiguity that was holding back the second wave of institutional allocation. Filter 1 separates assets with institutional access from assets with retail speculation. Most of the Clean 16 fail this filter immediately. Only 2 pass cleanly. We'll get to the rankings in a moment. Filter 2, settlement utility. Does this asset have a real institutional function beyond price speculation? This is where XRP's positioning becomes genuinely unique. XRP was not designed as a store of value. It was not designed as a smart contract platform. It was engineered from the ground up for one purpose: high-speed, low-cost cross-border settlement at institutional scale. Ripple's on-demand liquidity product is live in 40-plus markets. It uses XRP as a bridge currency to eliminate pre-funded nostro accounts, the billions of dollars that correspondent banks park in overseas accounts just to facilitate international payments. And on April 1st, 2026, the OCC finalized its rule on national trust bank activities, confirming that Ripple can operate as a chartered banking entity. That is not a theoretical development. That is a structural integration event that is already done. Ethereum passes this filter through its smart contract utility, DeFi, tokenized real-world assets, institutional settlement on-chain. The use case is different from XRP, but equally real from an institutional perspective. Most of the remaining Clean 16 struggle here, and having a use case is not the same as having institutional-grade settlement utility that is live, scaled, and generating revenue. Filter 3, liquidity depth. Can institutions move meaningful capital in and out without causing material price disruption? This filter eliminates most altcoins immediately. Institutional desks are moving hundreds of millions to billions of dollars. If daily trading volume cannot absorb that without significant slippage, the desk won't touch it. Full stop. XRP trades approximately $3 to $4 billion per day in global volume. Ethereum trades 10 to 15 billion. Ethereum trades 10 to... Bitcoin trades 30 to 40 billion. Those are the 3 assets that clear this filter without question. Solana is building toward this threshold. Chainlink and Avalanche have liquidity depths trending in the right direction, but they are not yet at institutional scale for the largest capital allocations. 3 filters. Most of the Clean 16 pass 1, a few pass 2, only a handful pass all 3. Let me show you the rankings. Tier 1, institutional grade. These assets pass all 3 filters. XRP. ETF pipeline. 7 spot ETFs. Now approved. Bloomberg called it at 95%. They were right. 1.44 billion in confirmed inflows. 164 million on day 1. A 35-day pre-approval inflow streak that tells you institutional desks were loaded before the starting gun fired. The sell-off on March 27th was not a signal of weakness. It was the engineered flush. Buy the rumor, sell the news, shake out the retail leverage, and reload before the real capital rotation begins. That is the playbook. It ran exactly on script. Settlement utility. On-demand liquidity live in 40-plus markets. OCC banking status confirmed April 1st. Bridge currency function embedded in the correspondent banking infrastructure. Liquidity depth, 3 to 4 billion in daily global volume. Sufficient for institutional scale allocation without material slippage. Thoughtful. One additional data point that does not get enough attention. XRP's available supply has dropped from 4 billion to 2.6 billion tokens in the last 18 months. Institutional buying pressure is absorbing supply at a rate retail investors are not tracking. XRP is currently priced at approximately 140, down 61% from its all-time high of 3 on 65s. That compression against regulatory clarity, ETF approval, and confirmed banking integration is what a coiled spring looks like before it releases. Goldman Sachs confirmed 154 million in XRP-related exposure in recent filings. That is not a rumor. That is a 13F filing. That is institutional money on the public record. Ethereum. ETF pipeline, operational. Spot ETH ETFs have been live. The March 17th commodity classification removed the last regulatory shadow, suppressing the second wave of institutional allocation. Settlement utility, the institutional tokenization layer, BlackRock's Bwaddle Fund, JP Morgan's Onyx Network. The institutional on-chain infrastructure is being built on Ethereum. That is not a retail development. That is the largest financial institutions in the world making decade-long infrastructure bets. Liquidity depth, 10 to 15 billion in daily volume, no question. Ethereum is path A. XRP is path B. Both are tier 1. The positioning thesis is different. The institutional qualification is the same. Tier 2, institutional adjacent. These assets pass 1 or 2 of the 3 filters. They have legitimate use cases, real communities, real developer ecosystems, but they are not yet at institutional deployment scale for the current capital rotation cycle. Solana passes filter 3 on liquidity depth, has an ETF product in the pipeline. but settlement utility is still primarily DeFi and consumer applications, not the correspondent banking or tokenization infrastructure that institutional desks require at this stage. Watch the ETF approval timeline here closely. If a spot SOL ETF clears in 2026, Solana's tier ranking moves. Chainlink passes filter 2 cleanly. Link is the institutional Oracle infrastructure, the data bridge connecting real-world financial data to on-chain settlement. BlackRock, Swift, and major financial institutions are already using Chainlink's cross-chain interoperability protocol. But the ETF pipeline is thin, and liquidity depth is not yet at institutional scale for the largest capital allocations. This is a sleeper asset that institutional infrastructure adoption could re-rate significantly. Watch it. Avalanche passes filter 2 partially. Institutional subnet deployments are real. Deloitte, AWS, and major financial institutions have built on Avalanche's institutional subnet architecture. ETF pipeline exists but is not yet approved. Liquidity depth is building but not sufficient for the largest capital allocations at this stage. Stellar Lumens passes filter 2 in a specific vertical. Cross-border remittance and central bank digital currency infrastructure. Multiple central banks have tested on Stellar, but the ETF pipeline is thin and liquidity depth is shallow relative to institutional requirements. These are legitimate assets with real infrastructure roles. But in the institutional capital rotation now underway, Tier 2 assets receive residual allocation, the capital that flows after the primary Tier 1 positions are established. That is not a knock on the technology. That is how institutional capital deployment works. Tier 1 first, then the rest. Tier 3, the rest of the Clean 16. These assets carry the commodity classification, and that legal development is real and meaningful. But they do not currently pass the institutional filters that drive primary capital allocation in this cycle. Dogecoin and Shiba Inu are here. The commodity classification removes legal overhang. Both assets have massive communities and genuine cultural momentum. In a broad bull cycle, they will move, but they are not part of the institutional capital rotation thesis. They are retail-driven assets in a cycle that is being shaped by institutional frameworks. Cardano, Tezos, Polkadot, Hedera, Litecoin, Bitcoin Cash, and Aptos all have legitimate technology stacks and real developer ecosystems. The commodity classification matters for all of them, but the institutional filter analysis places them in Tier 3 for this specific capital rotation cycle. Reassuring, that does not make them bad investments. It means they are driven by different dynamics, retail sentiment, developer adoption, broader market beta, rather than the institutional capital allocation flows that are driving Tier 1 assets right now. The mistake retail investors make is treating all 16 Clean 16 assets as equivalent because they share the same legal classification. Legal classification is the floor. The institutional filters are the ceiling. They determine how high capital can push each asset in this specific cycle. Here's the question every retail investor is asking right now. If the regulatory clarity is confirmed, if the ETF approvals are done, if the institutional inflows are documented, why is the price still suppressed? This is the shadow game, and understanding it is the difference between panic selling at the bottom and holding through the compression event. The sell-off on March 27th was not irrational. It was engineered. Here's the mechanism. When a highly anticipated event, an ETF approval, a regulatory ruling, a Fed pivot, finally arrives, the smart money that bought the rumor sells the news. They take profit on the retail-driven price run-up that preceded the event. The liquidation cascade of leveraged retail positions adds to the downward pressure. The price drops sharply. Retail investors, seeing the institutional thesis confirmed and then immediately followed by a price decline, conclude the thesis was wrong. They sell. That is the flush. That is the shakeout. That is the reload opportunity. The institutions that just sold the news are now buying back at lower prices. The retail investors who just panic sold are providing exit liquidity for the next institutional entry. The compression reloads. The coiled spring tightens again. This cycle has played out identically with every major asset class transition in modern financial history. Gold ETF approval in 2004, Bitcoin ETF approval in January 2024. The pattern is not a coincidence. It is the institutional playbook running on repeat. Now here is the forward trigger that matters most. BlackRock's XRP-related AUM is building toward a threshold that Stephen McClurg, CEO of Canary Capital, identified in recent commentary. $3 billion in AUM. That is the level at which BlackRock's internal models historically trigger a full institutional recommendation to their wealth management clients. Below that threshold, it is a speculative position. Above it, it becomes a recommended allocation across their entire client base. Post-approval volatility may have introduced some noise in the AUM trajectory, but the direction has not changed. The $3 billion trigger is the next structural milestone, and when it fires, the second wave of institutional allocation begins in earnest. That is the compression event. That is what retail investors are not seeing because they are watching price when they should be watching flows. Flows tell you where institutions are positioning. Price tells you where institutions have already been. Watch the flows. Let me bring the full picture together. March 17th, the SEC and CFTC classified 16 crypto assets as digital commodities. The legal foundation was established permanently. March 27th, the SEC approved 91 crypto ETF applications in a single session. The institutional pipeline opened. The market sold the news exactly as the institutional playbook prescribed. 300 million in leveraged longs were liquidated. Retail investors panicked, institutions reloaded. April 1st, the OCC finalized the National Trust Bank Rule. Ripple's banking status was confirmed, the settlement utility layer locked in. 3 events, 12 days, and most retail investors either missed them entirely or misread the price action that followed. The 3 institutional filters separate the assets that will lead this cycle from the assets that will participate passively. XRP and Ethereum pass all 3. A small group of Tier 2 assets pass 1 or 2 and will benefit from spillover allocation as capital expands. The rest of the Clean 16 will ride the broader sentiment wave. The compression event is not behind us. The March 27th sell-off was the shakeout, not the peak. The BlackRock $3 billion AUM trigger has not fired yet. The institutional accumulation window is still open. The retail investors who understand this framework will not be chasing price when the compression releases. They will already be positioned. That is why this channel exists. Not to give you price targets and not to tell you when to buy and sell, but to give you the institutional framework that lets you read this market the way the smart money reads it. Before the move happens, not after. If this analysis gave you something you couldn't find anywhere else today, hit subscribe, because the next institutional trigger event is already in motion and you're going to want to be in this room when we break it down. This is Crypto Corner with Steve. I'll see you in the next one.